president of the Afro-Caribbean Business Network, here in partnership with the BBPA, the Black Business and Professionals Association, and CAMC, the Canadian Aboriginal Minority Supplier Council. And Cassandra Dorrington's here representing CAMC, and she is one of our featured guests today that will be speaking more to partnership readiness and how to position ourselves to create these strategic alliances that we've been talking about. So to give you a bit of backstory, there was an emergency business meeting called a couple months ago. It feels like so long ago, but really talking about how as a community we can start to work together and create these strategic alliances so that going forward we can move as one unit with one message. And that was a real call out to the organizations that are Black focused business support organizations. So the three of us, and there's others that have also signed on to the coalition, to say what more can we do to support Black businesses in this community, in our community. So what we put together is a series of strategic building or strategic alliance building, capability building workshops. And this series is touching on like putting together your capability statement, putting together your finances and making sure that you're financially healthy, and also putting together what your market strategy looks like and how you present yourself to possible opportunities. And finally, how do we work together? How do we create strategic alliances to move as one unit and go after bigger contracts, and also get certified so that we can know what procurements and what types of social procurements are out there. The City of Toronto is building them, and lots of blue chip companies are also building them to make sure that we get access to these opportunities. And when we do get access to these opportunities, we are ready. Our businesses is in prime position to take it on and execute effectively. So today we're going to dig deeper into what financial health looks like for your businesses, understanding your financial statements. And Michael Pinnock is back with us. And then the second half will be with Cassandra Dorrington, the president of CAMC, to talk about what partnership readiness looks like. I'll give you a quick overview of Michael again, in case you were already here our last session, but he is a native of Jamaica. Michael immigrated to Canada in 2002 and spent the initial 10 years with a regional municipality in its corporate finance department, where as a senior budget advisor, he played pivotal roles in supporting a number of initiatives as subject matter expert. He's currently the treasurer at the Black Business and Professional Association, the BBPA. His other charitable activities include board and community work, committee work with the Ontario Children Foundation, York Region Children's Aid Society, and the York Regional Police, as well as treasurer for a number of charitable organizations. In addition, for over 16 years, he has served CPA Ontario as a tax preparer with his annual tax clinic and other volunteer work on panels. Without further ado, I'll hand it over to Michael to take us through the first part of our series today, understanding our financial health. Thank you, thank you.
Good morning, Ryan.
Good morning, sir.
And good morning to those who are on the chat. Again, as Ryan mentioned earlier, this could be constituted as part 2 of a 2-part series. Last time we spoke about personal finance and how one measures personal wealth and what it means and how one can use it to achieve personal, satisfaction and happiness, and can pass it on to the next generation. Today, we're going to spend the next 20 or so minutes talking about a similar stuff, but from the perspective of the business. Before I do that, though, I just want to mention something here. And I'm going to do it especially because we are in business. This seminar was scheduled to start at 11. And we waited until about 5 or 6 or 7 minutes past in order to get the folks to come online. And there's a saying that time is money. But if you're talking about, for example, the stock exchange, where you have 5G speed in trading, the difference between 11 o'clock and 5 minutes past 11 can mean a business went down. you can lose millions and billions of dollars in trades between going online and making a bid at 11 and going online and making a bid at 11:05. So one of the stuff I'd like to impress on my people and those who are online now is we have to take time far more important than we've been doing in the past. If we schedule to start at 11, we should have 500 people in the chat waiting to come on at 11, not one person and then two and then three and then four, and then eventually we'll ramp up to 60 or 70. And that has been one of the practice culturally that we need to break. Back in Jamaica, we call it the Jamaica time. Well, we're going to meet at 6 and someone will come at 9 and figure they're early. And guess what? People actually wait for them to come. So when they turn up, nothing is happening. And so this is what I'm telling you, not realizing that folks are waiting on a quorum. So I'd like us just to have that resonate with us, that let's try. It's not easy, but if you try, you can actually do it. If it's 11, it's 11. I will try to keep it as tight so we get out at 12:30 if that's the time we should get out, because people's time is very, very important. Today, the presentation is going to be very technical. And there's two reasons for that. Firstly, business is a technical stuff. The language of business is a technical stuff. And secondly, we need to know this from a technical perspective, because when we send our financial statements to various parties to evaluate, these parties evaluate us on a very technical basis. So we have to take it as it is, very technical. So if as I go through there is challenges and there's questions, I can take them as I go along, or we can wait for the end of the program to take
because I
all
think
the
that really
questions.
pressing to the topic that you're on at the moment, I'll interject and ask the
Okay.
question.
Okay.
But post it into the chat and I'll monitor it.
Beautiful. Perfect. So what we're going to do today is cover a couple of years. We're going to look at the primary legal form of business. We're going to spend a little more time on some of the details. Then we're going to talk about accounting as a language for business. Then we'll look at some of the analyses that we can go through that will tell us the health of our business, and also advise us to some of the stuff we can do to change that health if it's not healthy, if it's not strong, etc. We'll talk a little about risk and how we can manage risk, some of the options we have. And then finally, I'll touch on social enterprise, because that is it's not a new buzzword, but it's a big buzzword in the not-for-profit area as we look at the corporate form to do business. So there's three basic types of legal forms that we have. And when we talk about legal forms now, we're really talking about what is the authority we use to operate and to carry on our business. What is the legal framework we use? And so the first one, which is the historic one and long-standing one, is a sole proprietorship. And this is where just one individual is running the business. And then as the business grows, you may bring another person on board, or more than one other persons on board, and you can form what is called a partnership. And then the great big creature that we know a lot about now, as business get really huge and you need lots of money and lots of people to do things, you can go to what is called a corporate form of business. And so those are the three primary forms. All the different types of business you see in the world right now can be fit neatly and easily into one of those three categories. Either it's a sole proprietorship, it's a partnership, or it's a company, it's an incorporated business. And one of the main differences between the three, or one of the main difference between the three is the ownership. For the sole practitioner, one person owns the business. For the partnership, you have more than one person's owning the business. And for the corporation, you can have millions and millions of people owning that business. So let's look a little deeper in the sole proprietorship or the sole practitioner, or where just one person owning the business. So this one person has to do everything. The one person is a simple form to start. And people might ask, what is the legal form I can use as a sole practitioner? So in Canada, and most jurisdictions, there's what is called a Business Name Act, where you can register a name, and every 5 years or so, you pay to re-register that name, and the government will defend it in court if someone else uses that name. So as in any form, you can use that registration name. So as a sole practitioner, if you want to start something, you want to drive a taxi, or you want to be a carpenter or a mason or a plumber, and you want to do it as a sole practitioner, you can go ahead and create a business name, register that business name, and that's a legal form under which you work. Folks like accountants and other professions, there's a special act that governs them, and they tend to create what is called professional corporations. But I'll deal with that a little later. But they're also sole practitioners. They could just work as sole practitioners. And by tradition, me as an accountant, for example, as a sole practitioner, I can call myself Michael George Gordon Pinnock, chartered accountant, and I'm good to go. And that by its nature is okay. I don't need to do a special registration. But other professions and other avocations, it's best to register the name and practice under that name. One of the challenge here for a sole practitioner, I want to look at some of the risks that a sole practitioner faces. For example, first thing is that there's no difference between the individual and the individual business. It's a big challenge being a sole practitioner. There's no difference between you and the business. And therefore, if the business suffers a loss, that loss can come right back to your personal life. They call it that your liability is unlimited. Some of the benefits, or one of the big benefits, is that you control your business. You have 100% control over what is it you do and how you do it. And as you see, you are the master of your destiny. But that individual master goes with an exposure to risk. So if you're in the business of running things on your own, it has its ups and it has its downs. One of the things that you can create it simple. You own and operate by one person. The risk is unlimited, so all the profits you make go to you, and any losses go to you as well. The downside is you can actually lose your personal residence and other properties you have if the business goes south. Now, I'd just like to mention a little distinction between sole proprietor versus self-employed. Because everyone that works on their own and do something, some kind of a vocation or a business, is in fact a sole proprietor, and they're also self-employed. And so it seems to be interchangeable. But I want to make a distinction here between doing a hustle, just doing something on the side as a hustling, as I call it, turn of money, as against a sole proprietorship. What I'm recommending here is that if you're self-employed and you're seriously in business to make money and to be able to pass on any kind of generational wealth, you want to formalize it by registering the name, getting a separate bank account for the business. You're not able to get a separate tax code. You still have to use your own personal tax code, still file your T1, etc. But at least you get a separate.
Michael, real quick, what was that term you used? Turn of money?
Yes.
That's for a hustle?
Yeah, that's one of the buzz on the road now, where I just talked to a client just about 10 minutes before I came on, and they're in the trucking business, and they're now turning the money by buying trucks, fix it, and sell it. You know, and that is a good business.
Yeah.
But if you don't register that business, this as a self-employed now.
Right.
Because the term is used interchangeable. Sole proprietorship, self-employed. The difference I'm trying to say to folks is that a sole proprietorship, you want to formalize it into a business by getting a business name that you can register, and getting at least a bank account and separate the transactions in that bank account. You can't get a different tax status. You're not allowed to get a different tax status, but at least when you're doing your stuff, you can know what is happening in the business as against what's happening in your personal life. Because remember now, when you file your T1, all your income from whatever source is recorded in that one T1. And so you have some folks who work full-time somewhere or part-time somewhere, and they get a T4, and they're also doing something on the side. They're turning the money on the side, but they don't regularize it, they don't formalize it. And the downside with being a sole proprietor is that if something goes south, your personal life will go south with it. So, but that is a sole proprietorship, and that is in fact a form of business.
Cool.
Now,
and just quickly, with the slides, if you can make sure we're on the right one as you're talking.
Yeah, so Uju have to stay on target for me now. I'm moving up to the partnership.
If you look up and see that it's on the wrong one,
right. I'm going to the partnership now, Uju.
Cool.
Right.
And sorry, one question about the sole proprietor. Somebody asked, do they still need to complete a CRA T2125 form, or is that done away with?
No, that is exactly the form that you filled out for the business.
Okay, cool.
So somebody who, obviously that person know about the tax stuff. It's not a separate tax status because you have to do it under your T1, but you accumulate the information in the business part of your T1. And it's good to formalize it. So as we transition up the ladder, the next level is to where two individuals or more come together to form a business. It's called a partnership. And there's a lot of different ways. There's two basic forms. There's a general partner and there is the limited partner. And in fact, all partnership must have a general partner. So let's assume 3 persons come together and decide to form a general partner. What it means is that all 3 share in the gains and the losses, and they're not separated from their personal lives as well. It is similar to being a sole practitioner or a sole proprietorship. So if you're a general partner, you may decide to divide the capital and the income and the profits equally. So a third for 3, and all parties, their liability is a third of the overall liability, and that's a general partner. The limited partner, you need to have at least 1 person, and in our example where you have 3, you need to have at least 1 person that is general, and then the other 2 is limited. And to maintain that limited status, you can't be a part of the management of the company. You have to be a very silent and almost docile partner. So the sole practitioner may be doing a trucking business for argument's sake, and He started out with 1 truck and now he's at 20 trucks. Or he wants to go to 20 trucks. And so he brings in a silent partner that will buy the other 19 trucks. And he as a general partner will just keep running the business and pay some of the profits over to the limited partner. So in the case of a limited partnership, it still has the unlimited liability for the person who is the general partner, and then it's limited only to what that person puts in the business to the limited partner. And again, it has all the traits and similarities of a sole proprietorship. There's no separate taxation status. Each individual partners will take their share of the profit or the loss, and then they file their own T1 and pass it through their own tax status. But one of the benefit here is one of the benefit here, who drew the benefits? One of the advantages and disadvantages now is it's a little easier to set up. It's not as easy as a sole proprietorship, but it's not as complex as the next form. It's easier to start the business. You're sharing the risk. And one of the major ones to talk about all the time is that you tend to bring in partners when they're bringing something new to the business. And I suppose Cassandra will talk a little more about that in her segment when we talk about partnership readiness. What is it you're bringing to the table? You know, I've got the rice and you've got the meat. Can we prepare a meal? And so to talk about the decisions and the controls and the skill sets that they bring to the table, more capital that they bring to the table, etc. Some of the disadvantages is there's no independent tax status, not necessarily a legal status, because you do have a legal status in the case that they are, you know, there's a partnership act and there's a limited partnership act, and there's all sorts of special act for partnership that involve professionals like accountants and lawyers and doctors and engineers and different other types of partnerships there. So there's a strong legal framework, but the tax framework is the same like a sole proprietor. It eventually goes down to the individual partners. So the liability could be limited if you're in a limited partnership. Everybody else except at least one person would not be limited. One of the big disadvantages I like to raise is the potential for difference and conflicts. Remember, we mentioned earlier that as a sole practitioner or a sole proprietor, you're, you know, God for your little world. 100% you control. Once you go into a partnership, you start to give up some of that control. And you give up that control to share in the risk and rewards of the business. Okay? So that is the first 2 forms of business. The final one is the incorporation, the incorporated business. And this one, I must say to folks, first and foremost, this entity is a creation of the state. It's a creation of the government. The politicians went in parliament and they create this beast called an incorporated business. It's created by statute. It's over the years, and I'm not going to go back on history now, but the modern corporate structure we have has been through many iterations to get to where it's at. I think it starts way back in the 13th century, had challenges in the 16th century, big problems in the 19th century, the crashing of the stock exchange and all that kind of stuff. And where we're at now, it's riddled in a lot of complex laws and formal structures. One of the big unique factor about it is that the corporation itself is a separate legal entity from those who own the corporation. So remember now, the sole practitioner, the sole proprietorship, The person that owns it is also the same person that has that legal status. In the partnership, it's the same thing. The partners own the partnership. But in a corporation, the corporation is a distinct entity from those who own the corporation. And they call these people shareholders or stockholders, etc. The management of the corporation is operated by a special group of officers known as the board of directors. And there's a clear distinction between the owners and the business. Biggest advantage is that the liability is limited. And that is why in the early days, you see companies which says Michael George Gordon Pinnock Limited. That word limited is placed there to remind folks that the liability is limited. They've changed it now to put incorporation, etc., etc. And the Company Acts allow certain companies not to use the word limited and what have you. But in the days gone by, the word limited was placed there to remind folks that the liability was limited. So let's look at a quick structure of how a corporation, for the purpose of managing the corporation run. In the sole proprietorship, in the partnership, the owners and management and the entity was one and the same. In a corporation, you have the corporation as a legal entity, and the owners buy shares or stocks in this corporation. And what you'll find, you can have from one to, I don't know, billions of people owning a corporation right now. Those owners, though, are not the persons who manage the corporation like a sole proprietorship or a partnership. They elect what is called a board of directors to govern the corporation. And then the board of directors employ or appoint various officers to manage the day-to-day running of the corporation. So you have the corporation, you have the owners, you have the board of directors, then you have the management. And how the owners have a say in running the company is once every year at their annual meeting, or if there's a special general meeting to deal with something, or a special meeting, they will elect the board of directors. But having elected a board of directors, they cease to have any control over the business. And the business is now run by the board of directors, who give the instruction to the managers as to what they should and should not do. Now, as I said earlier, one of the major benefits of these types of corporation is their liability is limited. So if you buy a stock in a company for $1 and the company goes down, it's just your dollar you lose. And so if you have $1 million person, if you want $1 million, say, to start a business, a corporation, rather than ask one person for the $1 million as a sole proprietorship, or more than one person for the $1 million in a partnership. And as I say, some of the rules of partnership is that there's limited number of persons you can put in a partnership. That's a modern rule. Days gone by, you could have unlimited amount, but the modern rule is that depending on the type of partnership, there's a maximum number of members you can have, etc. In a corporation, it's unlimited members. So if you wanted $1 million, you can have $1 from $1 million person, $2 from $500,000, $4 from $250,000, whatever the max. And that is how you generate the capital you need. And then these owners are rewarded for giving you that dollar in what they call dividends. So at the end of the year, the board of directors will declare dividends, and that is how they earn money on, as you see, investing in that corporation. Let me just quickly look at some of the advantages and disadvantages, and then I come and talk about some of the specific descriptions we have. So advantages, access to funding. And I was about to spend some time on the stock exchange today, but I decided that may be for a separate presentation. But the origin and the real purpose of the stock exchange was to facilitate big corporations of getting funding. So as a sole proprietor, you start up with your own money, or you may get it from your family. As a partnership, you have to actually go out there and seek a partner to do what you do. But as a corporation, with the advent of the stock exchange, there is a forum, there is an area that people who have money that they want to invest will go there. And people who needs money to run a business go there. So you match the buyers with the sellers. And that's what they use to determine stock prices, etc., etc. So the stock exchange facilitates access to funds for these big corporations. They do a number of other things now, like value the company, etc., etc. But its primary purpose way back was to bring together individuals with money that they wanted to invest, and one or two companies who needed money to be invested in their corporation. Their liability is limited. And this is also limited by the courts. The courts will support a corporation going under, and all you have to lose is the value of the stock that you place in that corporation. And if something go wrong, unless you really did things in bad faith, like we saw happening 2002 and 2008 with the subprime mortgage and then the financial meltdown. Normally, if companies collapse just because of bad luck or change of market or something, nobody goes to jail and nobody loses their home. It is part of being a corporation. Another thing too is the lifespan. Sometimes as a sole proprietor, you start out, and when you die or you get tired and stop the business, that is it. Partnerships is also the same. One of the downside with partnership, but modern partnership allow for smooth transition, is every time there's a change in partners, someone retires, you want to bring on a new partner, the partnership agreement is dissolved and you have to start a new partnership. So the life is limited to changes in partners for whatever reason. In a corporation, the lifespan is expected to be unlimited. And it will go on until it will succeed the owners and the directors and the managers. Ford Company, for example, has succeeded a whole generations of Ford. Still carry the same name, but Henry Ford is no longer there. But it's still going on because it succeeded those original owners. Major disadvantage, it's very complex to get started, very costly. And one could read up all the stuff you need to do, articles of association. You have to put out a prospectus first. And all of these things in the current corporation is because of the problems they've had in the past. And if you were to read up a history of the formation of corporations and management over the years with the 1930 crash and so on. And there were crashes before 1930. There were crashes back in the 17th century. So the crash that they had in 1930 was a repeat of previous crashes. And so what you'll find is that the laws are very complex, and you need to get lawyers and bright accountants to do what you do. It's highly regulated. A lot of forms to file quarterly and monthly and annually. A lot of forms to file. And on a side issue is that there's still this concept of, or the reality of, double taxation. And simply put, the corporation is taxed as an entity on its profits, and then when the tax profits are then distributed to the owners as dividends, that dividends is also taxed. And so this is where this weakness about double taxation comes in. It's taxed twice. Our tax law in Canada has an adjustment that allow for some reduction of that double taxation, but it's still double tax. Okay. At the bottom, I've mentioned owner manager, owner director, director employee, and you'll see that in a corporation, people can wear many hats. You can be a stockholder, and you're still the managing director, or you're still a worker, and you're still an employee, because the law allows for the separation of the owners from the management, from the workers, etc. So you'll see when we look at private corporations, for example, you will have a whole bunch of owner managers there. Next slide, please. So before we go to the next slide, I think I may have missed something that I wanted to emphasize. The labels we place on, I just want to mention something on corporation before I move to the accounting. The labels we place on corporation, whether it's a public corporation or it's a private corporation, has to do really with the ownership type. A private corporation and the Company Act allow for that. And there's a lot of rules about it being private. The shares of that private corporation, the ownership, is not available to all and sundry. It's to a captive group of folks. And it's called a private corporation because the ownership, even though it is still shares, it's owned by a selected group, very close-knit, very private. And so private corporations, there's a rule how many members you can have and so on and so forth. So that's why they call it a private corporation. A public corporation, on the other hand, is where the shares are available for anyone who can afford to buy the shares. It's available to the public. And most of the time, the shares are made known through what they call an original public offering. Okay, so when they're going to go out to get the initial set of funding, anyone can buy the shares. Now, there's a distinction between a public company in the sense that the government owns the company and a public company in the sense that the shares are public. Government-owned entities in the past, like the hydros and the communications and so on, 20, 30, 40, 50 years ago, those utilities were owned by the government of the day. And people tend to call them public companies because they were owned by the people. But that is different from public companies that you can buy the shares. And what you find is that the government has been divesting a lot of those government-owned companies to the public now. So they're now becoming public companies in terms of one's ability to own shares in them. So that's just a little distinction there. There are also some other companies that the government create them by special act of parliament. A lot of the banks were created by the Charter Act, are specific. There's also a lot of the churches that were created by special act of parliament that allow them to have their liability limited, etc., etc. Not-for-profit organizations are also created by a special act. Prior to the act that they call the Not-for-Profit Incorporation Act, they used to have what they call letter patents, letters patent. And that is just to right the government give an entity to do what they do and they're not taxed on their surplus. So those are just some of the labels that work with corporation.
Yeah, sorry, just before we go on, I wanted to really dig a bit deeper into that. You're talking about incorporations live forever. And I feel like that's a big takeaway that we should really dig into. And I know there is a cost when you talk about, well, if you don't register anything, it's free. But if you just register a sole proprietor, it's like $60 to $80. And then a corporation can be between $600 to thousands of dollars. But that money invested up front really does pay off. And we're seeing it right now with what happened with COVID, that a lot of the incentives that came out from the government were specific to corporations, or you had to have payroll. There was a lot of infrastructure that you needed to have in order to tap into it. So that's where we need to be thinking, if we're going to be scaling our companies, sole proprietor might be a stepping stone, but we should all be working towards incorporating. And there's great resources that the BBPA has, and even ACBN, to help people through that process. And even if it's just consulting or actual lawyers and accountants that can help with the incorporation, the articles, your bylaws, all these things that look daunting, but pay mega dividends on the long run. So I just wanted to touch on that real quick.
Yeah, and that is so true. I did have clients who call up, and some were able to work some magic with, others we couldn't. But basically, governments like the corporate form of organization, because there's a lot of legality around it. There's a lot of controls around it. And as you mentioned, it supersedes any individual owners of shares right now. And in fact, a corporation can sue its owners as well as the owners sue the corporation. So it's a separate, it's a creature by itself. It's treated like an individual. I'm going to step up my grounds a little because I think I'm behind with time.
No
so
problem.
The part two of this, I'm going to go like really quick. No, so accounting is what I call the language of business. I'm certain it's not original. Can't remember where I heard it, but this is it. Accounting is a language of business. What we do in the books is what generate everything else. And one of the messages I'd like to leave with folks is that you really need to know accounting rules, or surround yourself with people who do know the accounting rules. So we always talk about know the rules and speak the language. I want us to act the language, know the rules and act the language. As you mentioned earlier, Ryan, a lot of the Black businesses that I work with during COVID here could not apply for some of the benefits because they weren't regularized and they weren't formalized. And it was difficult. People were paid, just paid casual rather than paid through a T4. So they couldn't demonstrate that they had a payroll, even though they were paying out sums of money each week. So we want to regularize it. So the objective here for accounting is just to provide information about the resources of a business and the claims against that business. And it's used for comparison purposes. You want to compare within periods of your own business, and you also want to be able to compare with other business in other industries. So I just want to leave these two words here. Resources are assets, and an asset is any item the business owns. I would have mentioned that when we did individual stuff. Claims are liabilities. It's items the business owe. At Ujo, items the business owe. There are a couple of things, what we call elements in financial statement, irrespective of how elaborate it is, or irrespective of what type of business it is. It's assets, liabilities, equity, revenue, expenses, gains, and losses. And so way back when I just started doing accounting, many months ago, the first definition I heard, and I found it to be so useful throughout my life, is that accounting is the collection, collation, and interpretation of business transactions. You collect the information, you group the information, and then you ask yourself, what is this information telling me? And we collect the information and group them in these 7 classes. Assets, the thing we own. Liabilities, the thing we owe. Equity is actually the difference between the assets and the liability, or is your ownership stake in it. Revenue is why you're in business. Expenses are the item you use to drive your revenues. And the other two is very, very technical, gains and losses. Gains is when you get cash flow from things that you're not really in business for. And losses is when you lose from a transaction for which you're not really in the business to deal with. For example, you are in the trucking business and you use trucking to all aggregates all over the place. And then you sold a truck. You're not in the business of selling truck, but you sold a truck and you got a little more than the truck at value in the books. That's called a gain. And if you sold the truck and you get less than what's in the books, it's called a loss. But the top 5 is the main items you'll see in the system. Let's go to the next slide, Uju. So we're talking about further talking about the finance. What are the set of financial statements that we'll have? There are 4 what they call general purpose financial statement. Next slide. 4 general purpose financial statements. There is the statement of financial position. Most people know it as the balance sheet. And what the balance sheet says to us is, what is our status as of this day? What are the things we own and what's the value? What are the things we owe and what are the value? And what is the difference between what we owe and what we owe, which you'll see in the equity section. Now, if you have a robust, strong balance sheet, then you'll have more assets than liabilities. And two of the main things we look at when we look at a financial position or a balance sheet is whether it is solvent, that is, we're in a position to pay our debt as they fall due, the things we owe, and whether it's liquid, whether we can convert those assets we have quickly into cash to do what we do. And you'll see an example later. Then we have got the profit and loss account, which is really a movement. What was all the inflow of money and the outflow of money, and what's the difference between the two? And that is why we're in business. So your profit and loss account is, you want to keep your eye on that one. That is why you're in business. You're bringing in money through revenue, but there's certain expenses that you incur in order to drive that revenue. For example, salaries, you have to pay for people to work for you. Marketing, you have to do to advertise the company and the product. The third statement is called a change in equity. And that really just a statement where you see is, I started January with $1. I do a number of stuff during the year, and I end with $2. And the final one is what is called a cash flow. Now, this is a very, very, very important document or statement for businesses, especially small businesses. Because as you'll see in a little while, the method of accounting we do is called accrual. And so you can show profit without having any cash coming in or going out. So this cash flow statement is a very powerful statement. And there's actually an axiom around it, which says revenues are vanity, profits are sanity, but cash flow is reality. If you do not have the cash to pay the taxes, you're in trouble. If you do not have cash to pay salaries, you're in trouble. Because those are 2 major components of a business that you have to pay in cash.
I'm
the
sorry.
Government will not take an accrual.
Can you, what was that tagline again? It was,
revenue is vanity, profits, sanity, and cash flow is reality.
Awesome.
So you can always plan all sort of stuff with your revenue, and it's great things to think about. You have to make a profit because that means you're seeing that's the business you're in. But if your cash flow is weak and not coming in, you're going to be in trouble because that's what you see day to day. And as I mentioned earlier, those 2 areas, taxes and salaries, are areas that you need to pay in cash. Can we go to the next slide, Ojo? Right, now I'm going to quickly go through these three. These are really, as I say again, technical areas, and you can read them afterwards. Materiality. Everything you do in life, there is something that makes a difference. And materiality in accounting is what will make someone change their mind from either doing something or not doing something. So when you go to make a bid on the supplier's proposal, you have to be careful what you put there, because sometimes just one line or one phrase or $1 figure somewhere will make that person either give you or not give you. Materiality. Going concern again has to do with the long life we mentioned earlier. One is in business, especially at the corporate level, and you expect to remain in business forever. The accrual basis of accounting, a lot of confusion to some people, but the books and records that we provide for the purposes of doing all these bids and what have you, they're done on what is called the accrual basis. That is, if you retain a lawyer to do something, from the very day you retain that lawyer, you have incurred a debt, even if you pay the lawyer 6 months down the road. If somebody purchased some goods from you today and they're going to pay you tomorrow, you recognize the revenue today, even though they're going to pay you tomorrow. And that's called the accrual basis. So you can have a business where you're buying on credit and selling on credit, show a beautiful profit, but you have no cash to pay salaries and the taxes. Then we talk about fair presentation. And this is really the rules that the accounting standard set is set. You know, you have the International Financial Reporting Rule, you have the Canadian Accounting Standard for Private Enterprise in Canada, and you have the Accounting Standard for Not-for-Profit. Those are what we call frameworks, and there are various rules that go with those frameworks. And if you're in compliance with those rules, then they say you're presenting the financials fairly. And that is where people like me as auditors come in. If you're not presenting it fairly, I will make the recommendation to adjust the book so it is in fact being represented fairly. I'm going to skip the other slides because these are examples of what a financial statement look. Can we go through those quickly? Can we go through it quickly, Uju? Yeah, so that's what those are the different statements, so you can look at them later. What I want to do now, I want to talk a little about the analysis. Right, stop there, Uju. Go back a slide for me. Right, there are thousands and thousands of financial analytic stuff we can do on ratios. This is the interpretation part. When I look at your financial statement, what story is it telling me? What message is it conveying? And I've just picked a few of them to mention today. As I say, you can do it inter-period comparison, what you did last year compared to what you're doing now, what you did last year this time compared to what you're doing now. Then you have the interbusiness and the industry. Company A, Huber, Company B, Lyft, they're in the same line of business. Why is one making 20% more than the other? You can do that interbusiness comparison. And you can look at the industry as a whole. Then you have some individual ratios that we can look at the numbers on those financials you saw earlier, and it can tell a story. There's a profitability ratio, there's a liquidity ratio, efficiency, leverage, valuation, and growth, and other. Next slide. And so these are the mathematical computation, and you can test them later. So profitability has to do with the ability to generate profit from the asset. That is why you get into business. That is why you rent a shop, you get some machines, you get some workers. It's to generate profits. And I just give you the three basic one here. There are thousands of them, but I give you the three basic. The gross profit margin, how much dollar you getting for each dollar of sales. Net profit, what is after tax, after expenses, percentage of sale. And the operating margin. If you borrow money, you want to know if you can cover your interest and taxes as a percentage of sale. And those three ratios tell you different stuff. The higher the number, the healthier the company. Liquidity ratio, the two basic one that we tend to use here is what they call the current ratio. Your current assets divided by your current liability. Because as you see with long-term assets and long-term liability, they'll take care of themselves over the long run. But you want to know this year, within 12 months, what is this ratio? This ratio is always very good when it's greater than 1. If it's 1 or less, you're in trouble. But if it's greater than 1, it's good. Acid test is for people in merchandising sort of business that have inventory, because you have to sell the inventory in order to convert it. So what they do is that they take your current asset, remove the inventory, and they do the ratio. Now, here again, anything below 1 is a challenge. Big challenge here. Next slide, Uju. The next slide I want to look at is efficiency. And again, this is how the business uses assets to generate sales or generate revenue. And there are a whole bunch of ratios here, but I just select these top 4. In fact, there's a ratio I love very much which talks about your cash turnover and that sort of stuff. But these are just 4 of them that we can use to measure the health of the business. The leverage has to do with borrowing money, using other people's money to do stuff. That's what they call leverage. Whenever you borrow, you use borrowed money to do stuff, they say you're leveraging. And this is the ability to meet long-term debt, principal, and interest payment. And you'll see those ratios there as well. Next slide, Uju. So I want to talk about some risks now. So the balance sheet, the financial statement I just show you, and those risk, those profitability, those ratios, is really how you interpret the financial information you have. That is used to assist you in interpreting the financials. So it tell you whether you're healthy or you're sick, or if the business is healthy or the business is sick. Those ratios and other ratios. And the beauty about these two is that this is how financial institutions assess your business. So it's the same ratios when you take a balance sheet to them or in the financial statement. They give it to their guru and they go through it and they see this company is not healthy. We should not give it a loan. Or this partner is not good. We should not combine them. These are some risks. And you know what risk is the probability that something will go wrong and you'll suffer a loss. Again, you can read all of these different risks. And if you have a question on them, I'll take it at the end. Next slide, Uju. Or go straight to the next slide. These are all a bunch of risks that you can look up. Options to manage the risk. And there are really 5 different ways we can manage risk. If you think about it, really 5 different ways. You can avoid the risk. That is just stay away from the stuff that is creating a challenge. Sometimes you have to accept the risk because that is the nature of doing business. You know, people take planes every now and again, and the risk is that it will fall from the sky. That's a risk that you have to live with. You drive on the right side of the road, the risk is that somebody may come over on you, but that's a risk you have to live with. So you accept those risks, or you don't drive on the road, or you don't take planes. You can compensate. You can set one off against the other. If you know that you're losing something over there, you can do something to gain over here, so it balances the exposure. You can transfer that risk through insurance or joint venture or partnership or what have you. And finally, you can reduce the risk by having internal controls, setting limits on certain stuff. For example, let's assume you're in the business of giving loans. You can set up a credit rating that says if someone does not make a certain credit rating, they can't get that loan. So you can reduce it by doing that. Sorry, I had to raise the last part of this presentation, but I think I just ran out of time. Finally, I just want to look at social enterprise. And this I want to say to all the folks that are listening. It is similar to all other corporations, but its emphasis is mainly on doing social good with the profits that it makes. and how it's owned. It could be owned socially as well. So you could have a private one where a bunch of non-profits buy into the shares, or a bunch of individuals who are just altruistic people. But all the legal and other stuff that goes with it is similar in a social enterprise. And it's not new. It has been around for a while, but every now and again, you will hear it pop up, given what's happening in the streets. And again, I give you a whole sort of verbiage that you can read up on it. This, I think, brings me to my long overdue end, and I will take any question you have, and thanks for listening. I think I went about 20 minutes over my time, so just bear with me there. Yes. So if there's any question, Ryan, I'll take it. If not, Cassandra, it's all yours.
Yeah, I didn't see anything specific, so I feel we are good to move on. Cassandra, you can get situated, and we'll go into the session about now partnership readiness. And again, as Cassandra's setting up, remember that our organizations are here to support you in this journey. So as we're talking about financial health, if you do have questions specific to maybe looking through your own balance sheets and income statements to understand where you're at, we do have these resources available to work with you one-on-one.
Ryan, can you see my screen?
Yes.
Okay. Okay, perfect. Well, thank you very much, Michael. And good morning, good afternoon all. What Michael has laid the foundation for really is when we talk about partnerships, it's really essential that you know your business inside out. And Michael tried to come, I mean, I'm much like Michael, I'm an accountant, you spend 4 years doing that and then you spend a lifetime doing that. He's tried to take all that, compress it into a very short time frame. So please, what he's given you is the highlights of some of the things you need to know. And this is only to make you very aware that as you go through this, financial understanding is imperative for you to be successful in how you go forward. So when Ryan, Nadine, and I talked about how do we make this happen, as we move into businesses are now looking to, especially with the social justice movement ongoing, they're looking for Black businesses. They're looking for a business to come on board. There's a lot of small businesses. And so there's a lot of opportunities when it's, are you big enough to scale? Can you actually meet the need? What we want to talk about is how do you actually partner together to be able to address whatever the RFP is and be able to deliver on that business. And so therefore what I want to do, and just spend the next probably 15 minutes taking you to what does industry alignment or partnership readiness look like? What are the key elements you need to be aware of as you move down this road? Now, the reason people think about when they talk about growth strategy, you do growth by your own, so you're just going to grow, you're going to, invest your own money in the business and do it and it's very organic growth. But the other ways is that you might do your growth by partnering with others, and you're doing it for 3 key reasons come to mind. One, you're looking for revenue. You're looking to drive sort of your bottom line, more money coming in the door to you. You're looking to drive your exposure, or you're also looking for the credibility of being associated with a larger organization, or you're covering more base because you're all together. So if I look at revenue in particular, as I said, for the revenue side of the house, if you're combined with somebody else, then you have that opportunity for more lead generation, more customer intelligence, more access to the network. And that's what you're looking for when you're coming to a bigger piece of the pie, or even a piece of the pie if you're too small to play in that arena. The next thing is when you're coming together with others, now you're going to start to brand and market that. So there's going to be some positive buzz about you coming together, that this partner that you're looking to align with, they might know a whole group of businesses that you're not aware of, and that pull your piece into that foray, and vice versa, that you might know someone that they're not aware of, and all of a sudden you get a broader base of organizations that you're exposed to that you might want to do business with. And I said the credibility that comes with when you're bigger, because if you run a business and maybe your top line revenue is 100 grand, and that's good, but you might not be able to bid on something an organization is looking for much deeper pockets on what your insurance look like and everything else. But when you work with somebody else and all of a sudden together you look like a $500,000 business, then all of a sudden it becomes, there's you're managing the risk better. The organization said, oh, that might be somebody we want to do work with. So there's reasons why you come together. The key thing I want you to think about is if you're even thinking about aligning with a partner, aligning to get drive business, there's a couple key things you have to be aware of. How are you going to pick the right partner? Now, indeed, this goes the same as in a relationship. How do you find the right mate in a relationship? Because I will say it's very easy getting in and very difficult getting out of this thing. So you have to make sure you make the right decisions. Let's start out by saying, if you're looking for a partner, you want to be able to say, what's their vision? Does it align to the vision I have? And so you really have to agree on that, because people operate differently depending on what their vision of an organization is. If someone's looking for customer service, but someone's looking for one body wants customer service, so they want to be able to spend as much time understanding what the customer needs, and somebody's looking to be quick in and out, and they're looking to do have as many customers as possible. Someone's looking for a couple long-term customers. You will operate totally differently depending on what your vision is. So you have to be very clear that you're aligned on the vision, because other than that, the actions will not align. The next one, if you're looking for a partner, the big thing is you want to be able to match strength to strength. So therefore, if I'm really strong in one area and you're strong in another area, then that makes sense, because together we can encompass so much more. But if we're both deep dish strong in the same area, what's the benefits of why we're coming together? You really have to address that. Years ago, when I was working in Trinidad, my partner that I worked with, we were both in that whole strategic realm, but I came at it from, I had deep dish compensation background and deep dish strategic planning, where she had policy background, and those items came together, that when we bid on RFPs for clients, we covered a broader spectrum, and that made more sense. So when you're thinking about a partner, think in terms of what the strengths you are and what are the skill sets they bring, and how does that create a bigger perspective of what you're bringing to the table. Michael talked a lot about money, and he talked about sort of reading your financial statements, but I'm going to take it from the other side, that if you're coming together and you're going to form either an alliance, or if you're going to come to a partnership, you have to determine how much money each of you are going to put in, or what that might look like. Because money will be the one that you'll end up severing on, if nothing else. Because if someone says, I'm going to put down 2/3 of the money, you're thinking, okay, 2/3 of the money, but we're still 50-50. If you haven't actually worked what that looks like, why would they give 2/3 and only get back 50% of the profits? So it has to be, well, maybe they're giving 2/3, but maybe you have this connection that you're bringing to the table. You have to determine qualitatively and quantitatively what each of you are putting in the business, and what that means from an equity perspective that you're going to get out of the business. These are very, very big questions, and these are long conversations to have, because then they have to all be detailed at the front end, because at the back end, that's when partnerships break up and people start to sue each other and things go awry if they are not worked out at the front end. How much time are you going to put in the business? So as a partner, you're going to come together and you say, we're going to bid on this business. Have you really determined, one, who's either going to own the client, who's going to run the business? I'm going to be 50% and you're going to be 50%. And they sound like minor questions, but when you get inside, if you're used to running your own business, you're used to, you bid on this RFP, you've got the RFP and you're running with it, but now you have a partner. How do they work inside it? You know, so you have to, these are very distinct questions that you have to start to work through. You know, how much time they're going to contribute, you know, who's going to be lead on this. All these details are things that must be talked about. Now, when people have partners, they tend to look at family members or friends, things like that. And so that's good in one way, but you still have to figure out how you handle conflict or how you go forward. So if I've known, it might be a friend that I've been in a business with or known for a long time. So I know their background and I know their personality and I know how they deal with conflict. But if I'm just forming a partnership for the sake of bidding on this contract, I might not have that idea of how you deal with conflict and how I deal with conflict. It might be totally different. And so we all know when we get into these environments, there's going to be some trying and stressful times, and how you work through this is important. So you need to know, each have to have a better understanding of how you deal with these situations, or they have to be detailed as to how you're going to deal with them. These are vital to going forward in business. Also, these are things, and you know, my Father's Day would be something to say, you know, we can have a handshake on that. Handshakes are nice, but you got to put down in writing. You got to be able to stand behind, you know, what the name of the partnership, what you've said for the contribution, so it doesn't get after the fact and you said, well, I thought you're going to put in 60% or 50%, but you didn't. Those have to be written down. Allocation, who's getting what out of the back end? You know, what your decision-making authority is, you know, what our guidelines are. How, if we're going to, and there's two of us to begin with, and we want to invite a new person in, maybe you say, oh, it's my buddy Joe wants to come in. I just told him he can join us. It can't be as informal as that. All these are things that have to be put down in some sort of a partnership or even a strategic alliance agreement. So when we talk about partnerships, could be very formal, but they could be, and strategic alliance could be less formal, but still has to be talked through and still has to be put down in writing. So you have a better understanding what you're coming to the back end. Last but not least, what's your exit strategy? You might come together just to bid on a particular opportunity. And so you might write it down. We're just going to bid on this and then we walk away from this. But at all times, you need to be able to make sure that what are we putting on the table to get in and what do we take away when we leave and how do we terminate this? And it's very clear in the light of day and sanity when you're at the front end, when you're putting this together, to walk through what does this look like and how are we going to end this? So therefore, that's all laid out, because other than that, when you're in the middle and all of a sudden you say, well, this is over, I just want to leave, I'm out of it, it might not be as easy to extricate yourself from the process you've gotten into, and it might not be as well for the client on the other hand. What does that look like from them? Do they actually get the service? So all these are details that you must take your time and work through. Now, what I've done is I've laid out like 7 big buckets of things, but behind this, what I have is I have sort of some key questions, and I'll send this to Ryan and you can have access to this through BBPA. But key questions I want you when you're going through this. So for the partnership, you know, one of the key things when you talk about the rationale, you know, what process did you use to select your partner? You know, do you have a clear understanding of the ideas where you're dependent on them? You know, what are the risks to either organization? One of the alliances I'm in right now, I've aligned with a couple other organizations because we came together for the purpose of addressing government. But what we had to talk about is, if we come together, what if someone wants to pay this alliance but not pay me? What does that mean to my organization? You have to think about, are you still going to be a stable organization on this side? Are you coming together for the sheer purposes of this one bid or bringing this together? What does it mean to the viability and the longevity of your own organization? These are things that must be thought through as you start to work through this. So when I say that it's a checklist, it's not a checklist as much as, or not a questionnaire as much as, it really is a process to think through each time. Again, shared values. We talked about, and when we talked about upfront, you know, selecting your partners. And I talked about this long-term vision and what the goal. Values are vitally important to any organization. Values are vitally important to any relationship. So you can imagine this business relationships, it's even more essential. You have to know if you both have the same values about how you treat your clients, how you treat your staff, how you treat timelines. You heard at the front end, Michael talking about time is important. Are you both tied to that? If we agree on a timeline, we're able to meet it. Or if someone says, oh, well, I'll get to it next week. That's your reputation on the line as you go through this. So values are vitally important that you talk through what that means to each of you. You know, what's the partnership purpose and what's the objectives? You know, you come in this for your common goal. What success look like for you as a partner? Have you defined what it looks like? So the fact you've signed on at the front end to say, yeah, we're going to be partners, going to bid on this. Is success winning that particular bid? What does success look like for you? Is it meeting the client's needs? Is it exceeding the client's need? Those are things that clearly, unless you sit in each other's shoes, you have to have that conversation about. And it's much easier when there's 2 of you have that conversation, but if you have a number of partners to come to it, it's a bigger conversation, but you have to be clear on what this looks like. Trust, as I said earlier, if it's a friend, it's different to say, okay, what do we trust each other? But if it's some other business person you're coming together, you know, the level of trust when your organization, if you're in a risky business, what does trust look like? What does commitment look like? These are key because whatever you sign on to brings your business and your reputation, your brand to bear. So these are things you have to make sure you have walked through and that you're very clear on what that looks like. And maybe that starts with a small piece of business you do together. You learn how each other works. And you learn when I can trust them, when they can trust me, I have your back. You move to a larger piece of business. But these are things you have to build in, talk about, and work through. Roles and responsibility. I'm used to running my own shop. You're used to running your own shop. When we come together, who takes over? Who does what part? Who's customer facing? Who's not? You know, how often do we update each other? These are key things that in your own business, you've worked those through. But when you come together either as an alliance or as a partnership, and then you realize, oh yeah, I forgot to tell you. It's not forgot to, you got to lay out what's our frequency of reporting. Who's going to own this? Who's going to be point on this? These are key things that will make or break your alliance and or your partnership. Partners, the whole implementation, as I talked about, how do you work on a practical level? Who's going to be your client-facing person? You know, you both might want to be able to develop a deeper relationship with this client. So you're feeling, oh, if he or she gets there, what's that mean for my relationship? That's part of the trust. That's part of what are you working towards? Have you laid out what that looks like? Are there clear lines of accountability? Do you meet on a monthly basis sharing what's gone on? After you're meeting with different clients, do you come back and share that information? These are all things that build in. How do you build up a really strong partnership or alliance that you actually trust each other, that I trust if I've taken this client, you've taken this client, we're treating them the same and we're sharing the information back and forth. The contribution and incentives, you know, what we put in and what we take out, those are key. I mean, if I'm working with an organization and maybe they have all the market connections, but I have all the, I have the monies, maybe that works together as the best way. And we're able to quantitate what that looks like, the strength of what each brings to the table to be able to say it's a 50-50 split at the back end. But you have to be very clear and you got to talk through it and you both have to agree. And I say both because it usually starts with 2 in a partnership, but it could be 3. You all have to agree, what does that look like? What does the risk of the return of the project look like? Again, simple questions to say, but not simple to have that conversation. Communication, again, these are strong. Again, are you able to communicate with each other? Do you respect the differences? You know, how have we incorporated agreed upon forms of decision-making? How do we communicate and publicize our partnership? All these things I want you to think about. We want to have at the end of this whole series of workshops, we want to have a couple organizations who want to have a strategic alliance. We want bigger businesses to come to the table, but we want you to be informed as you do that. We want you to protect and bring your strength to the table, but know who you're doing business with. The reporting, as I said again, you have to determine if you're 2 or 3 parties together, how do you report, how regularly do you report, what do you report to each other? How do you share that information? That's all going to be vital, that not one organization owns it, that you're able to share what that looks like, or there's a common repository where you host all that information. And last but not least, as I said before, the termination. If you haven't built your exit strategy, what circumstances will lead to you to terminating that partnership that you have? What's the process for termination? How will the service to the clients, or is that job all over? How will the service be maintained thereafter? One of my friends back home, they were in a partnership and they had a very successful organization. What happened is one who put the money down the front end, they sort of backed away, but because they hadn't worked out the exit strategy, when they backed away from doing anything, the other partners kept working and they were reaping the benefits of the partnership because they hadn't worked through the detail. So these are life lessons that once you know this, you take your steps to say, okay, these are things we have to talk about. These are things we've worked through, or you do it, as I said, you start small, that the risk is not that high, and then you build towards that. But you have to, either way, you have to start working through what these elements are. Overall, if I had to, and I've talked really fast because I know we want to end it, I want to end at 12:30. Overall, I want to say, you have to make sure if you're looking to walking into an alliance or a partnership, you align on vision and or values. These are things that will break an organization. You have to be very thorough and selective in who you partner with. Can't be just because, oh, they're a nice person. You got to be thorough and selective. This is your business on the table. This is your name on the table. This is your brand on the table. And then once you get into that, you've got to go on, you got to go beyond the transactional, and you got to be collaborative. And that's where you actually start to share what goes on. So it's not just you partner so I can get this bigger piece of business and goodbye. How do you collaborate? How do you come together as a strategic alliance to drive that business forward? Those are the key elements that's important for you in assessing this. As I said before, what I will do is I will make sure this, I will send this deck to BBPA, and all those who have attended will get a copy of this deck. So you can take a look at these questions. You can allow yourself to work through as you're looking for alliances, as you're looking for partners. These should be some of the key questions that form the foundation for your discussions. If you're able to start working through these, then you're able to identify where you see a strategic alliance coming forward. As I said, in my past history has been, I start small. I start with someone, we start to build on that, identify where the cracks in the armor are, how do you bridge those? And so therefore, you manage that when you get to the larger project, you now know who you're dealing with. You've worked out the kinks of who's in charge of this particular part versus this part, who owns this. You're building, and when it works well, when you're working in each organizational strength, it is phenomenal to watch, and you grow extensively. I say all that, and I talk fast, and I apologize for that, but I wanted to make sure I captured it because it really does piggyback up what Michael did. It really is key on what he talked about. The financial aspect is a strong part. We talked about vision, we talked about goals and values, but you also have to know your finances when you come to the table. You have to be very clear, because if your strength is financial, then they have to know that I have a lot of cash on hand, or I'm easily liquid, so we can manage all that. But if you're partnering with somebody who has, as Michael has said, it's a big business that it looks like they're making a lot of money, but they have no cash. What happens when you hit your first big bump in the road? From a partnership perspective, who bails out the bump? So you have to know your finances and then be able to align based on vision, values, to be able to have that frank conversation with each other. So having said all that, I will stop there and ask if there's any questions, or I'll leave it to Ryan to ask if there's any questions. Ryan, are you still there?
All right, I feel like we're good. Sorry, my computer glitched.
Sorry.
Oh, can you hear me?
I can hear you.
Oh, my volume was down. Sorry about that. Yes, thank you so much for that, Cassandra. I feel like, especially talking about partnerships, I know after our first emergency meeting, I was able to touch base with another gentleman in the automotive industry, and we're working on putting together a joint venture. For names, we're trying to figure out what to call it. It might just be us separate, but we also brainstormed Car Care IQ. He does mobile mechanic, I do mobile detailing. So talking about like how to move forward as one unit is very important, and those questions to ask each other is so important as well. So I'm looking forward into digging deeper into creating those partnerships. And that's what we want to see out of these workshops is, one, how do we solidify what we do ourselves? And then how do we bring more firepower to what we're doing and form of strategic alliances and partnerships? So this is recorded in case there's anything you want to go back. I know Cassandra felt like she wanted to hit the 12:30 mark, but I would have stayed here until 1 or 2 just to listen to you. So I really appreciate you taking the time. And yeah, if there's any specific question, I didn't see any.
Whitney had a question.
Oh, Anton?
No, as I said in the chat, I see Whitney had a question.
Yeah, in regards to a service business, is there a formula to determine the value of the business so you can determine the investment amount?
Well, I think that's back to Michael's talking about valuation of an organization. And so it's probably tied somewhat to the, okay, I hear feedback. Is that me or you?
Oh, maybe it's me.
Okay. Okay, I'm sure that's probably tied to sort of what's your past profit history and what's your client base look like. So from a goodwill, what type of contracts do you have? What's your past sort of financial record look like? So it would be trying to actually identify that. Michael, you want to talk more about evaluation of a service business?
In terms of what you'd like, because we value all business similarly, you know. In terms of a service business, the best valuation is to look at the future cash flows.
So if we're looking at creating some sort of partnership as to what I'm bringing to the table, how do I value my business versus someone else's business?
And there are classic ways of doing that, you know. Again, there's very technical way that you can do it. But if you're going into a partnership, then once you put the technical numbers on the table, then a lot of time the next is, as you explained earlier, what are the intangibles? Can we work together properly, et cetera, et cetera? Because from a financial perspective, I can value my business using historical balance sheet, using replacement value, using cash flow discounted, whatever the technique we have. And let's assume one business is worth twice as much as the other. That does not necessarily mean you're bringing twice as much to the table, especially when it comes into a partnership, because you may not be, let's assume it's a marketing company. Like in my case, I'm an accountant. I think I'm a very good accountant, but my president is a better marketer. So I may be bringing twice as much to the table, but if I want to sell my company, get more clients and so, I rely on her expertise more than mine because she's a better marketer. So
Yeah.
there are a number of ways you can look at it. I don't think there's one answer. Again, it has to do with the individuals that are involved. Ensure that from a technical perspective, you got the valuation tied down from a monetary perspective, and then you look at the intangibles.
Yeah, I agree with you. I think from a partnership, it's based, a lot of that's based on the intangibles. It could be based in your relationship to the potential client you're looking to do business with.
If you're selling a company and you just want to get rid of the assets or you want to get rid of the shares, that's a different kettle of fish. You try to get the best the market will afford. But if you plan to come together and work as one, like a merger, one of the biggest challenges in mergers and acquisition is whether the staff from either companies will work well. A lot of time you have a genius on either side. You have a Google and a Facebook. I would believe all these technocrats and technical people work well, but sometimes it won't. So the individual parts don't have that synergy that you're looking for. So that would be my stuff. First, you do the technical, ensure that from a money perspective, you understand where you're at, and then you have to do the soft stuff.
Mm-hmm.
And we're still working on how we validate stuff like, good faith in doing things.
Exactly.
Or you validate trustworthiness. What sort of monetary value you put on things like that.
Okay. Well, if there's no other questions.
I did see Dr. Grace asking, Michael, my organization did not qualify for some of the funding as you outlined. It was disappointing because we have a robust program. However, our fiduciary was not transparent. It is important to note that as organizations, we must be compliant and exercise good governance. Good governance and financial management must in capitals now become a priority. Sustainability of our organizations depend on it. Good governance and financial management must, again in capitals, now be a priority. The sustainability of our organizations depend on it. So more of a comment, but very timely. And thank you for sharing.
What I'd like to say there, Ryan, because I read it myself, and I use this word. There's a difference between business and hustling.
Mm-hmm.
Okay? You have some people hustle all their life, and they die as a billionaire. Okay? And you have some folks who just tried one business and they're still struggling. But I still go for the business because the business will survive these COVID and this sort of stuff while the hustling will not. The business has rules, and I always say to folks, one of the key components is that we need to understand the rules. So one of the challenges we have, I'm kind of just going off on a tangent a little, but one of the demonstrations, we have in marches and we have in demonstrations and we have in what have you. And a lot of them are turning ugly because we forget the rule. If you're walking on the street with 10,000 people, people coming at the sides, how do you manage that? What are the rules around people who didn't start at the get-go, but add as you go along the road and then becomes a problem down the road? There's a rule how you manage those stuff, And it's the same thing here with doing business. You pay a lot of folks and you call them casual. You call them part-time, you call them one-off. You don't pass them through the T4 because you believe you're going to save the 10% of the employer's contribution. Then there's a COVID and you can't put together a payroll, even though you have been paid out hundreds of thousands of dollars. So again, I see this whole concept of compliance. There's a rule for everything. We may not like the rule, but there's a rule for it. And until we can change that rule, which we need to be working on as we do stuff. We have to comply, or else we're going to have problems. So that's just my 2 cents, Ryan.
All right, awesome. Yeah, I feel like that's a great place to wrap up. Again, remember, all 3 of our organizations are here. Oh, can you hear me? Yeah, all 3 of us are here to support your businesses. I know going into the next session, we're going to dive deeper into continuing like this partnership readiness, finding out about the different resources, especially the certification with CAMC, how we can position ourselves for now, the opportunities that exist, and really move forward and start to amplify and scale our businesses. A big thing that really came out of the week, this past weekend, and talking with my business partners and different members in ACBN, is how do we get businesses not just to establish themselves, not just to incorporate, but how to scale them, and then have our founders, our Black founders, exiting these companies. A lot of times you find that you build something really great, but then you get voted out of your own company, and then the company might exit and you're not part of that success. All these different factions of business operations, we need to be very clear about, and understanding that when you are the mastermind that scales your company, that asset needs to be left to your children, needs to be still in the community as a whole. So sorry, Cassandra, you wanted to go on?
No, I was just saying it's so important what you're saying there. But what's utterly important on top of that is we need to have more Black businesses that we can promote and establish. I'm getting calls from people like City of Toronto, one of my members, City of Brampton's just come on as a member. I mean, I'm getting the Apples, and I forget who else. These organizations said, who are your Black businesses? So we need to have them. And you're right, we want them to build growth, economic wealth. And so therefore be able to either pass that along or get more of our people employed, because part of the social justice movement we have now is still the haves and the have-nots. It has not changed in 50 odd years. And how do we make that happen?
Yeah, so just to close out, we as organizations are here to do our best in that support. Reach out to us. Cassandra put up her information. I'll email out. You guys have been getting emails from all of us. So if you do not have my contact info, I'll send it. I think I put it in, did I put it in the chat? I'll put my number in the chat, in my email. Yes, and let us know how we can best support you. But I'm really excited about the next session. It's, oh my gosh, what day is this? It's not the 7th. Is it the 14th or the 21st?
It must be the 21st, but usually a 3 week out.
3 weeks, yes. So September 21st, we're going to dive deeper into, again, kind of continuing on about the partnership readiness and positioning yourself in the community to get these opportunities. So until then, I really appreciate you taking the time, and yes, looking forward to the next session. All right.
Take care, all. Bye.
Thanks for having me.
All right.